I just got off the phone with a bright young dentist. He was asking me a lot of questions, and one of the questions he asked me was, hey, I'm looking at this potential investment and it says 15% IRR. Is 15% rate of return a good return? Well, that's what we're gonna break down in today's video. What is a good return and what should you expect? But before we do all that, I wanna take the time to thank you for being here, and for people that I haven't met yet, my name is Dr. Jonny Walker, aka Dr. Jantha Withanachchi. Shout out to my tech guy. He put in all the air horns and all the sound effects. I'm a veteran endodontist, part-time now. I'm also the principal of a real estate investment firm that has done over $301 million of real estate transactions and have invested in 1,924 apartment units to date. We've helped over 100 dentists invest passively in real estate and develop multiple streams of income, as well as build wealth and get all the tax advantages of real estate while investing completely passively. Investing heavily in real estate has allowed me to take a giant step back from my clinical practice to part-time, spend enormous amounts of time with my family, my children, travel 6 to 8 times per year, as well as have the time to pursue things that I'm passionate about. And that's educating my fellow doctors and, of course, investment in real estate. Now, say you have two offerings, right? You're looking at two different deals. You have two different passive investment options. You know, if you go to these crowdfunding sites like CrowdStreet or Realty Mogul or Yield Street, whatever, all of those crowdfunding sites, you could go through a bunch of offerings, deals, and see a whole bunch of different IRRs, right? Or ROIs. Which are different metrics about rates of return. Now, say this young doctor that I spoke to, you know, the one that asked me about the 15% IRR. He was also looking at a second deal, and both of them had nice, beautiful pro formas, beautifully marketed. Everything looks and feels very high quality. And one of the shiny pro formas, the first one that he looked at, says 15% IRR is the projected return on this investment. And then he has another deal. The other deal has a 20% IRR projected return. So which is a better investment? Well, the specious argument is obviously I'm going to pick, these are both multifamily real estate deals, so I'm just gonna pick the one that has 20% IRR because I would rather make more on my money. Well, even though that's a specious argument, it's a cringeworthy argument and it's fraught with risk. Well, before you answer, okay, well, I have these two multifamily real estate deals and one is 15%, one is 20%, you have to make sure that you're comparing apples to apples. Hey, Dr. Jonny, didn't you just say they were both multifamily real estate deals? Aren't we comparing apples to apples? Well, in a general, very high level, generally speaking, yes. But when we're investing, we gotta go a little bit deeper than that. Consider this scenario. I don't know the specifics of the two deals he was looking at because they weren't investment offerings that we had. Let's look at the deal that has a 20% IRR, right? It's projecting earning 20% on your money per year for the life of the investment. Well, the 20% IRR property, it's a derelict property, kind of in a sketchy part of town. It's only 60% occupied currently. On top of that, the units are in complete disarray. Not only have they not been updated in many years, but there's also a lot of damage that you can see to the walls, to everything. A very rundown, almost homeless type of place. This property will definitely require extensive renovations, extensive remediation. Then they have to go in, whoever's buying this property, get rid of the non-paying tenants, renovate the units, increase the rents, generate a profit, and that's how we give you the return. That's a value add strategy. So it's gonna take a significant uplift, significant energy, cash, expertise to come in and not only renovate the units, but then operate the property, to transition the property from a sketchy, derelict, rundown property and try to transition it into something better. And then you have to implement systems and operations to make it efficiently run. Now let's compare that to the 15% IRR deal. Now this deal, the current owner hasn't really renovated units very much over the last 10 years, but he's done a very good job maintaining the property. The roof, the repairs have been done, the HVAC, everything is maintained relatively well. On top of that, this property is 87% occupied. Now you're starting to get a clearer picture. The 20% IRR has a much higher perceived level of risk than another deal that's already performing pretty well. No major renovations need to be done, just small renovations to the individual units to drive rent modestly. So now which is more favorable to you now, right? Which deal would you want to invest in based on now that you have this extra set of data, right? So it comes down to individual appetites and individual's level of risk tolerance. But I still haven't answered the question. The problem is that it's very hard to quantify risk because even if you look at a real estate deal, you have to consider the operator, right? Who's the sponsor? Who's the guy that's going to be actually running this property since we're passive investors? That part plays a huge play. Also, it depends on which market you're in. Right? Which submarket are you in? Is one of the properties located in a town where the population is declining and jobs are going to other places? Or is it located in a fast growing part of town where you have lots of people moving and lots of demand for rental? So These are other factors that we have to consider. But for the sake of this discussion, let's assume that we're only looking and comparing assets. So in this example, which would you go for? The 15% IRR return has a much lower risk profile because the complexity of their business plan is much less. So the return at 15% relative to the 20% seems very reasonable for that investment. Now, 20% for a much heavier lift, is that enough of an increase of return to compensate for the increased level of risk from deal 1 to deal 2? That becomes the question for you as the investor. So let's briefly consider the 4 types of multifamily real estate, and let's compare their relative levels of return and risk and what you should expect. So Class A apartments, which are newest luxury, right? Brand new, amenitized properties, right? They command the highest rents. They're located in the most popular and desirable areas with the best views. These apartments charge the highest amount per door. But with these properties, cap rates are also very low. So in these type of deals, investors don't expect a high level of cash on cash returns, but they expect a much higher amount of appreciation. Return to risk profile, Class A luxury type of properties are considered lower risk. Even though I would argue that during pandemic, when the worldwide pandemic and everything shut down, a lot of people that were in Class A moved to things that were affordable like Class B. But in general, the consensus is that Class A is the lowest risk, and as a result, you get lower rates of return and lower cash flows. But you have a much more stable and less volatile of all the asset classes. Class B apartments, which is what we love to invest in on Walk of Wealth Capital on our real estate investment side, is Class B apartments. We love the recession resilience of it. Cap rates are a little bit higher than Class A apartments, but this also has recession resilience because of the demographic that lives there. This is also called workforce housing. And the thing is, the demand for workforce housing never goes away. Class C apartments, on the other hand, the cap rate's even a little higher. These properties tend to be even older, typically over 30 years old. Class C assets usually have very outdated exteriors, interiors, and units. They require a much higher CapEx budget or capital expenditure budget or renovation budget. Class C also commands the lowest rent out of the 3 that we mentioned. Class A, the highest, Class B, then Class C. Then the last one is Class D. These are typically over 30 to 40 years old. These are usually very derelict properties. There's elements of criminal activity at these buildings. There's squatters and undesirables and non-rent paying people living at these type of properties. We don't even invest in, and so we will not even really talk about it. But there is opportunity, obviously, taking a property that you can buy for almost nothing, but it requires probably double what you're going to cost the building to make it livable and habitable again by humans. Those are development deals. This is beyond what we invest in. We like to invest in existing properties that have existing cash flow, etc. Justifiably, these type of development deals tend to have a potential for very high levels of return. But the trade-off is that there's also very high levels of risk. There's risks at the city and county level, getting the approvals and certificates of occupancy and habitability codes, etc. And of course, the risk with development is that, hey, we're gonna go in and gut this building and completely renovate it over the next 24 to 36 months. Well, when you extend it over construction over that period of time, you're also at the whims of the interest rate environment. There's just a higher level of risk when you have longer and bigger and deeper business plans, right? Deeper, intensive business plans. And you should be rewarded with very high rates of return with development deals. Now, if I get a development deal and somebody say, hey, we're gonna project a 20% return on this deal and we're gonna build a bunch of units, and I have the ability to invest in a Class B multifamily value add deal with everything else being the same, and it's also a 20% IRR. When I'm comparing those 2 deals, now I can say, hey, look, 20%, is 20% a good rate of return? Well, it depends. 20% is a great level of return in this market for a value add deal that's already 87% occupied versus 20% on a development deal where they got to gut the property and renovate it, and we're not going to see a single dollar for a tenant for 3 years, right? So now when you compare it like that, it's like, well, I think I know which one has a much higher chance of me getting that return. And I know which property is more likely to keep giving me passive cash flow every month or every quarter, whereas one I know with 100% certainty is going to give me 0, right? So it becomes a little bit easier for you to compare those 2 deals. You got to look at those returns relative to risk. All right, guys, that's all I have for today. I hope you got tremendous value. If you like this video, smash the like button. Throw me a comment, give me some feedback. I love to get feedback from you guys. Please share this channel with others who can benefit from this message. Click on the next video. We're going to keep the heat coming and your bank account's growing. Let's go. Boom.